So let's take a look at how your credit score impacts you. So which brings us to module number 2, credit scores and how to build it. What is a credit score, right? Just like in school and college, you get exams and assignments, and you have to do well on those in that course, right? In life, if you handle your money responsibly, then essentially you get a good credit score, right? So it's essentially a financial report card, and it really shows lenders and creditors how well you handle your money. The lenders use it and they see your credit score. They kind of assess your level of risk of like how likely you are to repay them back. Why is it important that you have a pretty good credit score, right? So number one, it saves you money. So the higher your credit score, the less of a credit risk you're considered, the better interest rates that you'll be given from these creditors. So if you were to purchase a home or a car or apply for credit cards, these all come with interest based on your credit score. Interest just means the percentage of extra they're going to be charging you for lending you that money. You know, if you have a really high credit score, as an example, you can get a 3% credit score interest rate, I'm sorry, on those loans, as opposed to if you had a bad one, you'd get maybe 5, 6, 7. It can also save you, make you a lot of money. You know, some people don't realize that if you have a great credit score, it means that you can also utilize those low interest rates and leverage your money in things like whether it's real estate, business, or any areas of life. Let's take a look at the credit score ranges. Your credit score ranges from all the way at the very bottom at 300 to a perfect score at 850. Your personal credit score is built on your credit history. A little background on FICO credit scores is this model was created by the Fair Isaac Corporation, also known as FICO, and it's used by financial institutions to deem your creditworthiness. And there are other credit scoring systems that exist, but by far, this is the most commonly used, accounting for roughly 90% of all top lenders. So you can see here, 300, 560s, where you get into the bad territory. It really isn't until you have maybe about above 700 that it's considered pretty good. Now that you have an idea what the ranges are, let's break down how it's calculated. And it's broken down mostly into 5 categories. The very first one is on-time payment history. Starting from the biggest factor, your on-time payment history, 35%. So payment history counts for 35% of your credit score, which is a big slice, right? And it shows your credit lord whether you're a person who pays their obligations on time. You're penalized in this category when you miss a payment, typically after 30 days, right? If a payment is past 30 days, then that's when they report it typically to the credit overlords and they ding your credit score. So that's, I mean, don't use this information as a way like, oh, you know, I'm at day 10 days late. I'm going to just pay it later. I still have 20. Don't, no, that's not the point, because you'll still get charged late fees, right? But typically they will not report you late and it won't have an impact until it's past 30 days. And then the more behind you are, the worse the impact. If you're 60 days late, that's worse than 30 days late. It just takes a more significant hit to your credit score. How do you improve this then? It's pretty obvious. You don't miss payments, right? It's simple. You just pay your payments whenever they're due. Don't miss it. You can't go wrong with that, right? Let's say you don't have the funds to pay for the entire balance. That's fine. As long as you pay the minimum, you'll be okay. They won't report you late as long as you're making just the minimum payments. So even if you're struggling to pay off that credit card, it's important that you pay at least the minimum. Another way to improve is that you can have several lines of credit. And I'll go into detail in an example coming up of how exactly that will impact it. Let's look at first the way this works. The way the credit overlords really calculate it is they look at your on-time payments and they divide that by your total payments, okay? And then from that, they calculate a percentage of payments paid on time. Let's look at a quick example. Let's say you've had one credit card for 5 years, right? That's 60 months total of total payments every month, one every month. And let's say in that 60 months, you've missed one payment, okay? Well, that puts us at 59 on-time payments over 60 total payments, which equals 98.3% on time. According to Credit Karma here, this is a scoring range that they use. You can see that that puts us right in the yellow category, which is pretty unacceptable if you want a great credit score. Looking at another example, going back to having multiple lines of credit, let's assume now that you've had 2 credit cards for 5 years, right? So now instead of having 60 payments, you have 120 payments. Again, you've only missed one. Now that puts us at 99.1% paid on time, okay? Again, going to this chart, you see that now instead of being in the yellow, you're in the green section. So let's expand that further. So let's say you had 10 credit cards for 5 years. So now we have 599 payments over 600, we've missed one, and that puts you at 99.8, almost near perfect. So the more lines of credit you have, the less of an impact it will have on your credit history. Not that that's an excuse to miss a payment, but again, that's just one way that it can help you with your credit history of on-time payments. The more lines of credit that you have available to you, the better you'll be. So next one, let's look at the opposite. Someone who's just a newbie, right? Out of high school, fresh in college, and you're thinking to yourself, okay, I just want to start my credit journey. Where do I start? Okay, how does it impact me? So let's assume you've had one credit card for 18 months and you missed one payment. This is kind of going to showcase how important it is, right? So now it's 17 out of 18 payments that you've made, which puts you at 94.4% paid on time. And again, looking at the chart, you can see that puts you in the red, which is just bad. It's horrible. Fortunately, this is going to take some time to recover from because there's not really any way that you could change this number. It's just you have to wait it out. I just want to emphasize the importance of making those payments on time, even if it's just the minimum. The next category is credit utilization. This accounts for 30% of your credit score. The way to explain this is, let's assume that you had a credit card for $1,000, right? You went and you bought yourself an iPad with it, and the iPad cost you $900. That puts you at $900 out of $1,000 used, which is 90% credit utilization. So that's really high up. You're using a bunch of your credit. But let's assume that instead of $1,000, you have $10,000. So 900 now is not 90%, instead it's 9%. So you can see that you're using a much smaller portion of the credit available to you. The way this is kind of looked at is you're penalized when you use a medium to high ratio of credit available to you. You guys can see the chart right here, right? It shows that 0 to 9% is really where you want to be to achieve the highest scores. Ways to improve this are, number one, don't keep a balance. So every time, if you're using credit cards, it's very important that at the end of every cycle that you pay off your card in full. Don't keep any balances on those. There's a myth out there that you should really keep a small balance so that they have something to report, but that's not true. Don't do it. Always pay your credit cards in full. Another way to improve this, again, is to apply for more lines of credit. The credit overlords, what they do is they look at your total credit. So if you have one card for $1,000 and another for $5,000, they combine those and they say, okay, this guy has $6,000 worth of total credit. How much of that $6,000 is he utilizing? If you have 10 credit cards and your total credit line is $30,000 and you have a balance across all of those accounts of $2,000, that's still very low in terms of your overall picture, right? So only 2,000 out of 30. You can see that he's utilizing very little of his available credit. And lastly, the way you can also improve this score is to just go and ask your lenders for an increase in your credit. So whether that's from your bank account, bank credit cards, Chase, whatever, just ask them for an increase, right? And so what that does is, again, going back to a $1,000 credit card example, if you have a credit card worth $1,000, you're using 500, that's 50% utilization, right? But if you ask them for an increase and they bump it up to 2,000, if you still have that same $500 balance, it's no longer using 50%, but now 25%. So that will lower your utilization, which will improve your credit score. And 30% again. So it's a big piece of the pie here. Let's look at the length of the credit history, which is 15% of your credit score. The length of your credit history is really just how long you've had credit card or credit lines available to you. The way that this is calculated is that they look at the average across all your accounts. An example, if I have one credit card again for 5 years, that means my average age is 5 years, right? I'll show an example in a sec. But for this, you're penalized when you open new accounts, right? Because if you open a new account, let's say I had that one credit card for 5 years and I open an account, so I have one for 5 years, one that's not even a year old. So they take the average of that, which is 2.5 years. So you can see how you're penalized if you open new accounts pretty often. You're also penalized when you close old accounts, though this is kind of caveat because it's not right away. So if you close old accounts that you don't use or accounts that you've paid off, they still stay on your credit report for 7 to 10 years after you've closed or paid off that account. If your oldest accounts are the ones that you closed, they'll still be on your credit report for that period of time, but once they fall off, it could have a negative impact on your credit history. So ways to improve this is you start as soon as possible. As soon as you can. If you're 18, just go and try and apply for your fresh credit card, and you just want to get the ball rolling on getting that time duration going, the credit history going. So you don't open new accounts constantly is another way that you can improve this. Be very, very tactical and mindful of when you want to open accounts. You know, you can't just be going crazy and opening accounts every other weekend just because you want to. So keep that in mind. Again, don't close old accounts. And then the last thing is you just have to have patience with this one. It's not really anything you can do to speed up time. So patience does go a long way with this category. And it's only 15%, so it's not like the biggest deal. All right, so let's look at that example I was referring to.
Alexa, stop timer.
Just, you want to mute yourself, Jess? Cool, thanks. Okay, so according to Credit Karma, they want you to have 9+ years of history in order to get the best rankings. Okay, so don't be too upset if you've just started your credit journey and you don't have a 760 credit score yet. You know, you'll get there. So you just have to wait this out. So let's look at an example. Let's say you've had one credit card for 6 years. You know, that's your average history is now 6 years. But which puts you here at in the yellow category. Again, you know, don't fret over how old your credit is. Me personally, I'm at 6 years average credit history, and I started my journey 13 years ago now. So you can see that it's not a big deal, and I have a pretty good credit score myself too. And then the next one, let's say that you decide to open a new credit card, right? So the average history is now 3 years instead of 6 because, again, they take the average, okay? Now that puts you in the red. All right, so moving on to number 4, let's look at the total credit lines and types of accounts, which account for 10%. So looking at this chart, the credit gods want to see that a person can manage a mix of different credit lines, like installment credit, such as car loans, mortgage loans, anything that requires steady payments until you pay off the balance in full. Revolving credit, which are things like credit cards, you know, it's credit that's constantly available to you as long as you pay off the balances. And on top of that, they want to see that you can responsibly manage several accounts simultaneously, okay? And here you can see that to get the best credit scores, they want to see 21+ accounts of credit. So quite a few accounts that you have to really manage. But keep in mind, like I mentioned, those accounts that you close or are paid off, they remain on your report for 7 to 10 years. So even if they've been closed or paid off, those still count as towards that 21 number. Okay. So ways that you're penalized is you have too few accounts. So, you know, that's if you only have 5 accounts, that puts you in the red. And if you close accounts, like I said, you really don't want to be closing old accounts, even if you don't use them. However, I put an asterisk here because there are a few companies that will close your accounts if you don't use them, particularly credit cards. So let's say you went to like Macy's or something and you got a credit card, but you haven't used it in 3 years. Sometimes they'll go ahead and close that for you because they have restrictions on how many credit cards they can distribute. So they see that you're not using it, so they're going to close your account, give it to someone else. So sometimes it's good to just once in a while make one purchase. You know, it could be a few bucks, and then pay it off, and that way they can see that you're at least using it. Ways to improve this is, again, obtain a strong mix of retail accounts, credit cards, and installment loans. And you're seeing a revolving thing here. Don't close old used accounts. Okay. The last category is number of hard inquiries. This accounts for 10%, right? And so what a hard inquiry is pretty much anytime you're applying for something, a new loan or a new line of credit, they run a credit check on you, right? And so this is considered a hard inquiry. There are other types of inquiries called soft inquiries where they don't really check exactly they don't print out your entire credit history report is what they do, right? So they see how many payments you've made and if they're on time. They can do a soft report, which won't have an impact what will impact your credit score. Like I said, you're penalized when you apply for new lines of credit, whether it's a new credit card, a new loan. They have to see that you are eligible and responsible enough to pay them back. So then that's when your credit score will take a hit. Ways that you can improve this is open as many credit lines at once if possible, right? So as an example, let's say you want to, start your financial journey. The best thing to do is maybe open 3 cards at once. That way they're all considered part of one inquiry. Open as many lines of credit early, and then your inquiries can also be grouped together. So what that means is, let's say you're shopping around for a home or a new car. What you can do is, people tend to shop around, right? So you're not going to go to the first bank you see and say, okay, Bank of America, you're the first bank that I saw, so I'm going to go and get my home mortgage with you, right? So no, the credit overlords assume that you're going to go and shop around. So let's say you go to Bank of America, you go to your credit union, you go to Logix, you go to Chase. Those are all institutions that are going to run your credit. What they do is they assume, if they're pretty close together, they assume that you're shopping around. So all of those inquiries are technically counted as one hit on your credit report. So it won't take such a significant hit. Last thing I want to mention is hard inquiries stay on your report for 2 years, but they only impact your score for 1. So a quick recap. Here are the credit score ranges. You can see on the left, they range from 580 all the way to 800 in the different categories. And here on the right, here are the categories and weight. Again, payment history having the biggest piece of the pie at 35%, followed by credit utilization. So what are some ways that you can monitor your credit? Okay, there are a bunch of free services that are available to you. I personally use mint.com, but there's others like Credit Sesame, Credit Karma, Annual Credit Report, and even banks offer free credit monitoring. They'll send you a report once a month saying what your credit score currently is. You can use all of these tools to stay on top of your credit score.
I have a question. In regards to your credit inquiry to be grouped together, can you be a little more specific? Like, should I make my inquiries within 7 days, within 14 days, within a month?
So I would say probably within 2 weeks. I don't have the answer to that specifically, but the closer together they are, the better. We're going to be sending out a kind of cheat sheet workshop for this, so I'll make a notation to see if I can find the answer to that, and I'll throw that in the worksheet. They say, I believe it's 30 days.